Hello dear traders, my name is Belugina. I'm the head of analytical department at FBS, and I'm very happy to start with this week with you at this Forex webinar. As usually, we will discuss the outlook for the Forex measures, the outlook for this week, for the coming trading days, provide some fundamental and technical analysis, and then summarize and give trade ideas. So let's begin. And our week is from today, Monday, May 29th to Friday, June 2nd. This will be the start of summer, finally. So new season is arriving at the market as well. Let's start our talk as we have a tradition to do with the analysis of commitments of traders by Commodity Futures Trading Commission, or in short CFTC. You can see that on the left I have the chart of the aggregate US dollar position. This is the position of large speculators, large players, which determine the trends in the Forex market. And last week we have discussed that the overall net long US dollar position increased, but I reminded you that the overall trend is to the downside. The overall trend is for the market players to reduce their bullish exposure to the US currency. And you can see that the fresh data for the week which ended on Tuesday, May 23rd, the incoming data showed that indeed the amount of this aggregate US dollar long position declined and actually reached the lowest level since September of 2016. So since the beginning of 2017, we have this negative trend in the market's positioning on the US dollar, and for now, the indications are that this negative trend will continue. So if you are thinking about the bigger picture, if you are planning some position trading, you certainly need to take this information into account. And if we break this positioning versus the US dollar in several currencies, we'll see the following picture. We'll see that during the past week there were some changes in the market's position versus the US dollar, and large net short positions decreased in such currencies as British pound, Japanese yen, and the euro as well. The euro, we have increase in bullish position of the market. So this shows us that there are negative developments in the US dollar versus these major currencies, and that the market is covering short positions in British pound and Japanese yen. We can see that among the market's net long positions of the currencies, the biggest net short positions, the biggest net short is in Canadian dollar, and then goes Japanese yen, Swiss franc, and British pound. The net short position for Canadian dollar has increased a bit, but we see a reduction in the market's bearish exposure of the British pound and Japanese yen. As for the euro, it is the largest net long position in the currencies, and there was a substantial increase in this net long position during the week, which ended on Tuesday, May 23rd. We just need to use this data to find out the underlying trends in the market, and I think that stronger euro and weaker US dollar for now represents a trend. And as for currencies like British pound and Japanese yen, the situation is a bit more complicated. But overall, I think that these currencies are a bit undervalued versus the US dollar, while commodity currencies, on the other hand, Australian and New Zealand dollar, are a bit overvalued and may decline in future. If we look at the US dollar index, we can see that the decline of this asset has paused for some time. The lowest point which the US dollar index reached was at 96.70. Then the currency index managed to stabilize a bit and is trading in the area between 96.70 on the downside and 97.50 on the upside. We can see that the US dollar index is retracing the decline, the recent decline from a high around 99.76. And we now are at 23.6% Fibonacci retracement level. This is the first Fibonacci mark. And we can see that the index formed a higher low. This point was fixed on Thursday. And a break above the neckline of this formation, which may be a double bottom, a break above 97.42, will make the US dollar go up for a deeper correction to the upside. And in this case, above the Fibonacci level at 97.40, we'll target levels around 97.87 and probably the area of 98.23. This is a 50% Fibonacci retracement. So some potential for increase in the US dollar exists, but if the US dollar index is not able to overcome resistance in the area of 97.40, 97.50, then we'll see continue of consolidation in the region I've mentioned, and on the downside, the lower border of this consolidation range will come to focus, and we'll target levels around 97 and 96.70 for the US dollar index. In the longer term, despite the fact that the US dollar has potential for correction to the upside, it should be difficult for the American currency to return to bullish trend. A positive thing which helped the US dollar to improve its position by the end of last week was the release of the US preliminary GDP figures on Friday. Preliminary release is the second release of American GDP after the advanced figures, and in a month from now we'll get the final GDP reading for the first quarter. And this was a bright spot on Friday because the US economic growth in the first 3 months of 2017 was revised to the upside from 0.7% to 1.2%, so almost in 2 times. And this is certainly a sign that the slowdown in American economic growth wasn't as big as it was previously discussed, wasn't as big as some analysts and experts have feared. And these data certainly give the US Federal Reserve green light to proceed with the rate hike at June 14th meeting. We know that the market is really ready for June rate hike. Here I have the information from the futures market, the futures on the US federal funds rate, and the market is currently pricing in the almost 85% possibility of a rate hike by 25 basis points on June 14th. This possibility has increased, and well, I think that the Federal Reserve has done a good job in preparing the market to a rate hike, so I don't think that we'll get a disappointment at this June 14th meeting. On Monday morning, there were some hawkish comments from San Francisco Fed President Williams, and all in all, the picture looks positive with this GDP data and positive comments. At the same time, I can hear many opinions that because of the softening business investment and moderate consumer spending, we won't see the US economy accelerate in the second quarter. So as this rate hike on June 14th is already completely priced in the US dollar, the US dollar's rate. So this won't give the US currency a significant bullish driver, and it won't help the currency to return, let's say, above 98 points in the US dollar index. The markets will be very interesting, not at what happens on June 14th, but the market will be interested in what happens next. Will the Federal Reserve be planning another rate hike this year, or is this one the last rate hike? And depending on comments from Janet Yellen on June 14th and other incoming information, the market will get cues for where the US dollar will head next. If the Federal Reserve shows that it is really hawkish and it is seriously considering another rate hike or rate hikes this year apart from June, then it might be the case that the US dollar will be able to return to this uptrend. Otherwise, if the Federal Reserve is cautious, if the Federal Reserve is not sure that Donald Trump will proceed with his tax reforms and not sure that American economic recovery will continue as planned, well, in this case, we'll see the US dollar test local levels, and this consolidation we are currently witnessing in the US dollar index will be a flag, a continuation pattern, which will signal the continuation of the bearish dynamics in the American currency. So we currently see that there are problems with Donald Trump's administration still. There are some investigations, there are rumors about the connections of this administration and Russia, and this doesn't create a really healthy climate for the American dollar. So in the absence for now of strong Federal Reserve's drivers, I don't think that this week we'll get a lot of bullishness for the US dollar. In case we see that the currency fails to get above 97.50, we'll look for entry points for the short trends. Otherwise, we'll look for a chance to sell the US dollar at the higher levels. I can remind you that Today there is a bank holiday in the United States, so liquidity is rather low, but we'll get plenty of economic data this week, so this week will be rather market moving. On Friday, probably the most awaited release, American non-farm employment change or non-farm payrolls for May. At the same time, no surprises are really expected from this data. The figures are expected to be decent. So I think that the US dollar will manage to test some higher levels. So we'll expect the market to test resistance, but we don't think that this attempt to get higher will be really impressive. So I think this is how I can describe this situation with the US dollar in the best way. On Tuesday, pay attention to core PCE price index, as it's the main price gauge and inflation gauge used by the Federal Reserve. So when the Federal Reserve speaks about low inflation or high inflation, it means this indicator, core PCE price index. Personal spending and consumer confidence will be also rather important. Speeches of FOMC official on Wednesday, take it into account, and some data like Chicago PMI, pending home sales, ISM manufacturing PMI, which is on Thursday, will also add to the economic picture we have for the United States. So some positive things may materialize, but they will unlikely represent a strong driver for the US dollar, as the market is ready for a rate hike on June and is not ready to make assumptions about what will happen next in the United States. So this is kind of picture with the US dollar. And then I think we'll slowly move to our charts and discuss fundamental picture for other currencies as we are analyzing them. So of course, we start with euro dollar, as it is the most popular currency pair, and I think everyone wants to hear about euro dollar first. I like this pair a lot too, and let's start with the weekly chart. We can see that after a very strong, a very big bullish candle, which was formed not last week but a week before that, last week's candle resembles the so-called shooting star. We can see that the euro tested levels at 1.1268, but failed to close at this high and ultimately closed the week in the negative territory at 1.1180. This is certainly a sign that the bulls were not ready to continue the breakthrough, and after such candles usually we get some attempts on the market to test lower levels in order to gather the buyers for the new movement to the upside, at least. So looking at this chart, it is natural to focus on levels like 1.1135. This is a Fibonacci level, and the next level is at 1.1070. This is the upper border of the Ishimoku cloud, which is currently bearish on the weekly chart. So this is the weekly picture. When we switch to the daily chart, we can see that I have here my favorite indicator for the weekly analysis. This indicator is called pivot point multi-time frame. probably like this, it will be seen better. We can see that here the levels of resistance are rather close to each other, resistance and support. The first red and the third blue levels, they form the range between 1.1245 and 1.1138. The levels are rather close, as during the past week the volatility in the euro dollar has decreased. So the scope of this variation for the euro dollar provided by the indicator has also decreased. The weekly pivot point is located at 1.12, and as long as we stay below this level, it is said that the overall dominance at the market is by the bears, and the pair is vulnerable to test lower levels. The weekly pivot indicator provides us with the downside targets at 1.1138, 1.1096, and 1.1030. These are a bit different, you see, from what we had from the weekly chart, and one can combine these levels, maybe draw them on the 4-hour chart in order not to miss anything important, not to miss important levels. We can see that on the daily chart MACD MACD indicator is declining and is getting ready to get below the signal line, and also stochastic indicator is also going to the downside. So some not very positive picture here. If we have a look at the daily chart with some moving averages and with Ishimoku as well, we'll see that the general trend is positive, still positive. There is a positive intersection of the moving averages on the euro dollar chart. The 50-day moving average went above 200-day moving average, and the lines are getting ready to make a positive setup, but the current prices are rather far away from the moving averages. So there is the scope for the prices to return a bit lower, to return a bit closer to the moving averages, as it usually happens during trends. So we don't have all the time the directional move. We have the phases when the market is moving in line with the trend, and then we have corrections when the market is kind of returning to the average levels. And this is also confirming the case that the pair may test levels around 1.11, 1.1070, and maybe 1.1030. These will be good targets which are in line with the overall bullish bias for the euro dollar. If we are talking about the fundamental picture for the single currency, then it is necessary to remember that the fundamental outlook is mainly positive, as we have significant decline in political risks in the euro area. We have positive economic data, and some figures are really impressive. For example, German IFO business climate indicator, which was released last week, rose to the record high, and we know that Germany is the main economy of the euro area, so this has to tell us much that the German economy and the European economy is healthy. Also, there were flash PMIs, manufacturing and services PMIs for the euro area. These were data for May. And these leading indicators showed us that the European economy is really, really strong. So these are bullish factors for the euro dollar, and some bearish factors may come from the temporary strengthening of the US dollar. In addition, some factors connected with the policy of the European Central Bank may also pull the euro dollar lower for a short time period. The case with the European Central Bank is the following. The pressure for the ECB to start declining its massive monetary stimulus is now building. And in fact, there are several positions within the European Central Bank. One of the top ECB members said that it is necessary not to hurry with reduction in stimulus, but other top member of the European Central Bank, on the other hand, said that if the European Central Bank waits too long with reduction in monetary stimulus, then the situation may get worse. So this week we'll find out what the European Central Bank's President Mario Draghi thinks on this issue. Mario Draghi will speak later today. He will speak to the European Parliament, and I hope that his position may clarify the situation a bit, and well, traders will get a better sense of what to expect from the European Central Bank's June 8th meeting, which will be next week. So this week will have a kind of preparation from the European Central Bank, and it will be interesting whether Mario Draghi acknowledges these positive developments in the euro area, or he still sounds cautious. If he sounds cautious, then we'll see some covering in bullish euro positions, and the European currency will test lower levels. It will go towards 1.10. On the other hand, if Draghi admits that, well, all is better in the euro area, then we'll get, I think, another go for level around 1.13 and maybe higher, 1.1350, 1.14. We know that the European Central Bank is not usually really interested in making the euro expensive. So Draghi is known by his ability to talk the euro down. We'll see whether he waits for next week for the European Central Bank's meeting to do so, or whether he will just want to use the unpredictability side and to drop some surprise, to drop some bomb at the market today. So this is why I think we should be very attentive in trading the euro. And technically, I think that the euro wants to get to lower levels. So I would consider this correction to the downside as the main scenario for the near term. Our days of the week will also bring some data. On Tuesday, focus on German preliminary CPI. On Wednesday, we'll get flash inflation figures for the entire euro area, as well as German retail sales, and some Spanish figures on Thursday and Friday. This is, of course, less important than data releases on Wednesday. Let's have a look at other currency pairs. Let's have a look at the British pound here. Probably a weekly chart is for us where to start. And last week we were talking about the weekly Shimoku cloud. I told you that this cloud is rather heavy at the chart of the British pound US dollar, and indeed this cloud did act as a resistance for the British pound. We also can see that this cloud corresponded with the with the psychologically important level of 1.30. The bulls in GBPUSD didn't manage to get above this level as well. So we saw that the market kind of recoiled to the downside from the resistance line, which may be drawn through this year's highs of the pair. The pair is still above the high of January, around 1.2705, and there is also support of the 50-week moving average, which is also located near 1.27, just above this landmark. So I think this will be an important support. If the British pound is able to stay above this line, then consolidation is expected. I don't think that this week will be able to get above 1.30. I think that 1.30 is a ceiling for the British pound, and if the currency approaches this level, I would think of closing my bullish positions. But below 1.27 certainly will be very vulnerable for a decline to levels around 1.2550, 1.2515. So it may be a leap to the downside here. Let's switch to the daily chart, have a look at the pivot levels. Here, the weekly pivot is located at 1.2873, and we are currently trading below this level. The pair is also approaching the support lines formed by the daily moving averages. We can see these lines here. The brown one, the 50-day moving average at 1.2730, and the horizontal line 200-day moving average located in the area of 1.26. So these are further levels to have a look on the downside. 1.27, 1.26. Easy to place oneself with these levels. Fundamentally, the British pound's mood was kind of worsened by the terrorist attack in Manchester, which happened last week. And this terrorist attack affected opinion polls, which are published in Britain ahead of June 8th general election. I can remind you that British Prime Minister Theresa May wanted to strengthen her negotiation position in Brexit talks. So she called for a snap election on June 8th, and she was hoping to solidify her power base. She was hoping that her Conservative Party will have a big lead over the opposition Labour Party. But this latest developments showed that the lead of Conservatives over the Labour has narrowed, and this leads to uncertainty. The market has already priced in Theresa May's victory in this snap election, and when we have these opinion polls data which tell us that her victory is not that certain, or it might be a really difficult victory, that it won't really solidify her position as it was expected. Of course, the British pound is suffering and is testing lower levels. I think that Theresa May will still manage to win this election. We can judge from the general picture of what is happening in the UK. She is still the biggest leader in Britain right now, the person who is taking responsibility of this Brexit process. So I think she will, and I think that this decline in the British pound looks more of the temporary event. We see that the market players are reducing their bearish bets on the British currency. So slowly but surely the British pound should be recovering, and on the declines to the area of 1.27, I think that the buyers should appear, that overall trend should improve. But as this week we won't have some answer on this election question, I think that our target should be conservative. Our targets on the upside should lie around 1.2970, 1.30. If we look at the British economic calendar, today, Monday, is a bank holiday, and the most important things I think will be on Thursday and Friday. On Thursday, manufacturing PMI is up for the list, and on Friday it's construction PMI. So flash data for British economy always will be quite welcome by the market. So last week there were some negative pieces of information about the UK economy, and analysts have once again started saying that Brexit is finally affecting the UK, and it is very interesting thus to have a look at these manufacturing and construction PMIs this week. If they confirm the negative picture, then I think that it will be another signal for the market that the move in British pound to the downside may be lower, and we may test 1.26 mark. If it is good, then well, all the reasons for 1.27 to hold and to make the market once again focus at 1.30. We remember that 1.30 is a really hard not to crack for the market. There is a really heavy weekly Shimoku cloud at 1.30, so I wouldn't think beyond this level on the upside for the British currency. And moving further, move to Japanese yen. Weekly chart first, and well, the previous week wasn't very interesting for US dollar Japanese yen currency pair. We are trading above 200-week moving average located at 110.70, and within this just sloping resistance line which goes to the downside and which limits the currency pair in the area of 1.12, 1.1270. There was another ballistic missile test in North Korea these days. However, we see that the market players have got used to these missile tests and this news from Korea. So it doesn't give Japanese yen great reason to strengthen. Some concerns about problems in Donald Trump's administration surely affect the US dollar, and it prevailed the currency in closing near the last week's highs around 112 and made the pair return to 111.30. So I don't see significant bullish drivers from the United States this week. I think that the currency pair dollar-yen will manage to stay above this weekly moving average if American currency is good. Once again, the market is expecting a rate hike. The market is expecting a good labor market figures. So I don't think that the bears will try to make this attempt to test significantly lower levels in dollar yen. But reasons to strengthen are really limited, and I think that every step higher for the US dollar will be quite difficult. So well, don't expect some great momentum here. On the daily chart, you can zoom in and see that the pair is kind of consolidating. It is trading near the 50-day moving average, and on the upside it has 100-day moving average, the green line, which is located at 112.40, and on the downside we have 200-day moving average, the yellow line, at the area of 110.10. So these lines are kind of converging towards each other, and I think that these lines will form a range where the pair will be situated in the coming trading sessions. So I think that if dollar yen moves towards one of these lines, we should expect that it will recoil from these lines in the opposite direction. So the green line will provide resistance, the yellow line will provide support. And weekly pivot levels also show that we are currently in the middle. We are currently close to the weekly pivot mark. We are also seeing that the weekly pivot levels, the first red line and the first blue line, which are closest to the current price, also provide us a kind of range. So we may also construct our trading this week working inside this range between 112 and 110.70. This is a bit closer range than the one between the moving averages, but it might be more productive and easier to work inside this range, as once again I don't think that the volatility here for dollar yen will be very high, and main drivers once again will come from the United States. Picture in Japan is not so important. Data are of low importance in Japan's economic calendar. But if we are talking about the market's risk sentiment, I would like you to pay attention on Wednesday, as on Wednesday we'll get release of data in China. China will release manufacturing and services PMIs, and as it is the largest Asian economy, the world's second largest economy, of course China's figures affect the risk sentiment greatly. The forecasts are that Chinese indicators have deteriorated, so lowering in Chinese manufacturing and services PMIs will likely increase demand for the Japanese yen, and will get to test levels around 110.70, 110.15. But I think that decline will be limited, then the market's focus will return after Wednesday to the US, labor market data on Friday, and to the upcoming Federal Reserve's rate hike. So all these is a kind of my trade idea here, that we will test the levels around 110.70, 110.50, and then return to levels around 111, 111.50. I think this is the most likely scenario for this week. Before having a look at some commodity currencies, let's quickly check what we have in oil. This is the daily Brent chart, and I would like to point your attention to the fact that Brent was consolidating around $54 per barrel last week before the meeting of the petroleum exporting countries on Thursday. Then it turned out to be that the meeting has disappointed investors, that the market has priced in more aggressive and extended output cuts than those which were delivered. So we got this big bearish red candle under the chart, and the prices tested levels below $51 per barrel. Some recovery took place since then, but all in all, I think that it will be hard for oil to return much higher than $53 per barrel. This is not good news for commodity currencies, certainly. We can see that Australian dollar has met resistance at this bunch of moving averages we saw on the daily chart. We spoke about this moving averages and this resistance last week. And well, this worked. We are now back below 0.7450. Some previous resistance, now support line, is helping the prices and helping hold in the area of 0.7420. But well, we think that the currency is vulnerable this week to just a bit lower levels, not significantly lower, but levels around 0.7380. Resistance levels are at 0.7450, 0.7485, and 0.7515. Here are some economic events which will be important for commodity currencies. Pay attention to China manufacturing PMIs on Wednesday. They are important both for Japanese yen and currencies like Australian, Canadian, and New Zealand dollar. Australian data will come out on Tuesday, and more importantly on Thursday. Thursday will be an important day for Australian dollar. There will be private capital expenditure figures and also Australian retail sales. Private capital expenditure shows us inflow into Australian economy, and these figures are released once in a quarter, so this is why they are really important for Australian currency. For Canadian dollar, pay attention on Tuesday and Friday, current account and trade balance. And for New Zealand dollar, financial stability report of the Reserve Bank of New Zealand will be out on Wednesday. And well, New Zealand dollar is feeling better than its Australian peer, and managed to test levels above 0.70, go above the 100-day moving average at 0.7050, and is getting up to 0.71. This should provide resistance for the currency. And if we correct the weekly pivot levels here, just refresh this indicator. Oh, here it is. We can see that the first weekly resistance is located at 0.7120, and the indicator shows that there is potential for bigger gains in New Zealand's currency, gains towards 0.7180 and even 0.7280 in perspective. So support levels around 0.7016 are pretty good, and a return to these support levels will likely provide new buying interest. But well, checking the weekly chart, we see that really in the area of 0.71 we have 50-week moving average, and this level should provide resistance. So it is a big obstacle for the prices here. And Canadian dollar, in line with our expectations, in line with what we were talking about at the beginning of last week, we tested lower levels, around 1.34. Canadian dollar has strengthened, then it weakened as the meeting of the petroleum exporting countries provided disappointment. But still, the general weakness of the US dollar is kind of preventing the currency pair from returning above the 50-day moving average at 1.3488. So this is a resistance, and here we may get consolidated picture as oil prices will consolidate. So this currency pair may consolidate between 1.34 and 1.35 somewhere. So this is it. And now let's have a quick conclusion about the things we have discussed today. US dollar is trying to stabilize this week with some positive GDP figures, and the market is expecting positive data from the US labor market. However, these are some temporary factors for the US dollar, and we don't think that this upside will be really strong. So we are waiting for higher levels in the American currency to sell the US dollar higher. Euro is still trading in a bullish trend, but it looks like from the technical point that the currency wants to test lower levels around 1.1135, 1.1070, and it may happen that the fundamental picture will provide a reason for the euro to visit these lower levels. The British pound is discouraged. The picture ahead of the election, which will take place on June 8th, has a bit deteriorated, but the overall bias is bullish, and we expect the currency to have support around 1.27 if the UK labor market is good, if the UK manufacturing PMI is good, and if not, then 1.26 is the next important support. Dollar yen looks poised to test lower levels around 110.70, probably 110.15, before recovery to 111, 111.50 this week. And commodity currencies show us different pictures. Australian dollar recoiled down and is trading below 0.74, may test a bit lower levels. We'll watch data from Australia on Thursday. While Canadian dollar remains strong, we likely consolidate with oil prices, and we remember that the market is currently extremely short on Canadian dollar. So it is difficult for the market players to increase their negative bets on Canadian dollar, and consequently it is difficult for the market to increase bullish bets on US dollar, Canadian dollar currency pair. So this is why the upside looks difficult in this currency pair. This is it for today. I thank you for your attention, and will be very happy to see you at my next webinar. I wish you good luck in your Forex trades. My name is Belugina. I'm the head of analytical department at FBS. And see you next time at FX Trade. Thanks a lot and goodbye.